For years now, world-class Elliott Wave technicians have talked about Nasdaq peak prices at around 14,000 before the bloodbath begins. Now a technical map has emerged that fully supports this theory. Here are the technicals that let you know when to hold them and know when to fold them. By studying the market giant and putting its technical jigsaw pieces together, we can equip ourselves at understanding any forthcoming moves. For just like a parabolic Nasdaq run will grant us spillover profits en masse, it will at the same time set the scene for some never-before-seen drama. And that's when the real fortunes stand to be made for whomever comes prepared. Here's how beautifully the technicals come together in the US Nasdaq index, a possible and invaluable roadmap for the most critical times ahead of us. The most significant part of this episode, and what truly makes it relevant, is that the technical combination we're about to go through is exactly how the previous two crashes were defined and could have been detected. But before mapping out the probable road ahead of us, do note that nothing in this episode is financial advice. These are my own thoughts and conclusions only. And if this episode clears the picture of the present situation of the US Nasdaq and what likely lies ahead, then please drop a like and make sure to subscribe too so that you can follow this development firsthand. Now, dating back as far as 3 years, renowned Elliott Wave technicians have talked about Nasdaq peaking at around 14,000 before the entire world economy house of cards comes crashing down all over our heads. This sure is something I've had in the back of my head for a long time, and I have now identified several key technicals that individually and collectively support this insightful thesis. A gathered perspective that might very well provide us with a clear roadmap to navigate our way forward. First of all, the price has surpassed the major 1.618 fib level, the prime one throughout this entire 11-year bull market, which makes it highly significant. The 1.618 on its own is typically critical as it acts as a reversal if the price fails to break above it. In this case, however, the price has broken above it and thus gives us clues of more to come. In this sense, the next point of interest is the 618 fib between the 1 and 2.618 fibs. A rejection here would be a textbook topish behavior. We saw it prior to the 2008 crash, just to mention one, and it is a frequently occurring technical behavior to mark the end of a markup phase, or a market cycle if you may. Now, this is where things get really interesting, for this very target is also backed up by this ascending triangle on the daily. Of course, triangles like these can go either way. However, in this case, the RSI is within our bullish red RSI channel and with multiple clear lower bullish red line touches, which together make it a strong case for a bullish continuation. The technical target for this formation, should we get a northbound outbreak, is at around 13,500. This would nicely align with the 618 fib for a possible spike into 786 land. Again, just like the peak in 2007 prior to the crash. Now, so far we have a 3-point bearish divergence on the weekly, and this also applies on the monthly chart. And the further this goes on, the more of a rubber band effect it will have on the price once it breaks, especially when they occur on the weekly and monthly time frames. This on its own would make perfect sense, as it would signify a blow off top and the beginning of a severe distribution phase. In such case, we can expect some serious volatility, one in which both the price and the RSI will retrace back up to the 618 or 786 fib and the upper bearish blue line respectively. We saw this exact turn of events in the recent two Nasdaq crashes, the IT crash in particular, and we see this copy-paste behavior in the most serious equities right before any severe markdown takes place. However, the RSI behavior in particular is the most important of them all to keep an eye out for. And for a full disclosure of these RSI strategies, please watch the RSI trilogy. And given that this triangle has more to give until it's technically ready to erupt, statistically we're talking mid-December to mid-January, this would likely amount to some further downwards moves and increased volatility in the short run. We already see temporarily emerging weakness on several other markets where prices are retesting the all-time highs, but where there is yet predominant weakness all across the board, regardless of what the price action alone may tell us. Of course, this triangle may at any time evolve into something else, an ascending channel, a mere double top, or whatever have you. But with or without the triangle, we still get the technical targets in the 13,500 ballpark by applying the 618 fib between the 1 and 2.618 fibs. Without directions, it's difficult to find our way without getting lost. For that reason, I hope you appreciate the major advantage in having been given this neatly assembled technical map. For there sure is a lot of money to be made on the upside, but even more so on the downside. That was all for now. Thank you and goodbye.